Setting a stop loss in trading is going to be the best thing that you ever do for your account ever. But are you setting them in the right place? And that's one of the things that traders often get wrong, is that either they set it too wide or they set it too short and basically get stopped out of the position unnecessarily. And in this video, we're going to talk about 3 different ways that I currently use in order to set up my stop losses when I'm trading, just to make sure that I maximize the trade as much as possible. So here is a chart on gold, and this is the analysis that I posted last week. And as you can see, the upside is playing out nicely. So just to give you an example of how I would set a stop loss in this particular market, let's just say hypothetically, if you got in where I said that this is a potential entry. So this would have been more of an aggressive move, basically because we had all of this consolidation here and the market basically didn't know what it wanted to do. So what I would do, the first method I would use would be the Fibonacci retracement tool. And if you're not familiar with this, please read up on this, because this tool is not a magical, mystical tool like everybody claims it to be. Basically, I see it as more of a ruler, and these levels that are on the Fibonacci retracement tool are basically just levels that are key levels that traders tend to look for inside of the market. So to some degree, it actually becomes more of a self-fulfilling thing, but I still love to use them inside of the market just because I've been able to save myself quite a few times by using the Fibonacci levels as a stop loss. So let's just say hypothetically that you got in here. We're just gonna mark this off from this bottom. And when you're using these levels, you want to make sure that you are starting, if you're looking to track the market up, starting from the bottom and then going to the top of the wick. So let's just zoom in here. And as you can see, I got a whole bunch of other levels on my chart, or at least on my Fibonacci tool, but do not worry, we're not going to talk about those at all, and they're not important to what we're about to do right now. So when it comes to this, so I just want to make sure that I got this perfectly lined up on the wick. Some people draw it on the body or some other ways, but I like to draw it on the wick. So basically I'm measuring this impulse right here. So this is the bottom. And right here, this is going to be the top, so where it ends. So just make sure that your 100% is at the bottom, and then your 0% is going to be at the top of this move. Okay, so let's just say I got in, after this candle right here. We're already above the level that I was looking to enter. All right, so now that I got my tool placed, let's go ahead and just pretend like I entered right here on this candle. I'm going to set, this is a really wide stop loss because it's a really big candle, but let's just say that I wanted to actually place, let's just say a 50 pip stop loss, because that's typically what I like to use inside of the market. Sometimes a little bit more, sometimes a little bit less, but 50 is about average. So let's just say 50 pip stop loss, and I was trying to go all the way up here to 26.87. This is actually like a real target of mine. But anyway, so 50 pip stop loss. And now that we got price above this 0, so what I would use is some of the extension levels going to the top. If you're looking for a simple way to analyze the gold market, then you need to check out the Profitable Gold Market Blueprint. You're also going to get some profitable entry levels and strategies that I currently use inside of this market. Maybe you're tired of just missing out on gold's big price moves, wondering how people are catching hundreds of pips, sometimes thousands of pips. And if you tried to understand this on your own, but ended up feeling overwhelmed by all the charts, reports, and all the things that you got to look at, you don't have to think about that at all. It doesn't have to be that hard. You can unlock the secrets to consistent profits inside of the gold market. And this is going to be insanely helpful for you, easy to follow with clear and actionable steps. Some of the things that you'll learn inside of this is learning to decode the gold market trends like inflation, FOMC, geopolitical risk, and so many other things. And then you'll master these simple strategies that follow the big players. So basically the banks and institutions, you'll learn what they're doing and how to find the information for what they are doing. And then also you'll be able to spot profitable opportunities and avoid some of the common traps that people fall into when it comes to gold, so that way you can stop second guessing yourself and just enter the market at the right time. And then you'll also understand key support and resistance levels, so that way you can anticipate the moves instead of just reacting to them. And then, of course, you'll save hours and hours of research because all of this is condensed, compact, and just ready to use. So check out some of the things that people are saying about this. This is actually one of my fastest selling products, and this price is not going to last long. So go ahead and check out the Profitable Gold Market Blueprint. This clock will have a countdown, and once the timer runs out, the price will increase and you will have to get it at the new price. So check this out. You won't be disappointed. So you may see a lot of extension levels, but the one that I like to use, or the ones that I like to use, are the 0.27% and then also the 0.61.8% and then 100. I've seen people with other levels in here. If you want to add additional levels, go ahead. It couldn't hurt. For me, it's just too much visual clutter, so that's why I only have these two. But let's just say I entered right here, 50 pips stop loss, and then price got up to this 27 or negative 27% level. So what I would do at this point is actually move my stop loss to break even. And as you can see, this break even point is essentially where the 0% is. So that would be a level right there. And then let's just say it moved all the way up here to the 61.8. Now, looking at this move right here, there is the potential of getting stopped out, especially because gold tends to do a deep retracement. So when price gets to this level right here, what I would actually do is take this, pretend like this is my stop loss, and we're also looking at the fib levels. I would place it a little bit below. Now in this situation, I would have gotten stopped out. If there was a really strong trend inside of the gold market, then I would have been fine. But basically this would be in the area where I would place my stop loss. And sometimes I wouldn't place it directly on the level, but just a little bit below the level, just because price tends to kind of move violently around these levels, and you just kind of want a little bit of buffer. So something like 5 pips, maybe 10 pips or something like that on gold is usually what I do when I'm using the Fibonacci levels as a stop loss kind of area. So then let's just say we didn't get stopped out and price got up to this 100%. So I would do the same thing. So I would trail my stop right below the 61.8. And there have been times where price has gotten pretty much 1-2 pips away, including the spread, 1 to 2 pips away from my stop loss, and I'm still in the trade. Like, that's happened so many times, especially on gold. But that's why I like using these Fibonacci levels, because as you can see, that even though in this situation price went up to the 100% or the negative 100% for the extension level, then it did come down back to this level, but basically just rejected this level and then continued to push up. So that's why I like to give it a little bit more room as well. So, and then basically I would just continue to do that. So you can see for the next level, it went up to the 127 and what, like, you know, a little bit below. Let's measure this really quick because we want to get precise. So sometimes it's, okay, yeah, this is quite a bit. This is like 30 pips, but still not bad. But basically, if you have it somewhere around here, you might get stopped out, you might not. You just have to be okay with that possibility, especially because a market like gold is very volatile. And a lot of times I just want to take my money and run just because price can reverse like that. Like, it just takes almost nothing for gold to reverse sometimes. And there we have it, using the Fibonacci levels in order to place my stop loss. And in this situation, one thing I was thinking about, if you just wanted to, you can measure what this was. This was about 40 pips, and you could use pretty much that same kind of distance at the next levels in order to place your stop loss, just so that way it'll give you a little bit of buffers. So 41 pips is not too bad of a stop loss, but basically let's just say for each of the levels in this given trend, it may differ for other trends. Then you could probably trail your stop loss right at that 41 pip kind of level, and you can see that it gets close, but it doesn't touch it. And basically that's your way of possibly staying in a trade. Like I said, it just kind of depends on what the market is doing. Sometimes there'll be really shallow pullbacks, on the gold market where something like 10 to 15 pips could work. In this situation, it's looking like 30, 40 pips would work. And then in some situations, it's even larger, like 60 pips, which is kind of insane, but it's the gold market. But basically, that's just another little tip that I have used in the past, and I wanted to mention it here in order to kind of measure what the difference has been from the actual fib level down to the low, just like we see in here, and just kind of using that also as a guide in addition to the fib levels in order to make sure that I trail my stop loss appropriately on the gold market. Okay, so another thing that I have been using is trailing my stop loss based on market structure. And this was actually one of the first methods that I use inside of trading. And it was a method that, or it's a method that I continue to use on various markets. And when it comes to trailing my stop loss based on market structure, I actually feel a lot more comfortable with that, because if price breaks market structure, then it may be a sign for me to get out of the market in the first place. So it actually serves as kind of like a sanity check, because sometimes I know for me when I'm in a trade and let's just say it's moving like this, I'm like, I don't want to get stopped out because I have the potential of maybe going up here, just like it just tapped into right now, but it has the potential of going up here. And say if I get stopped out here and I see it later, it did all this, then I'm kind of mad. So that's just, a little peep into my own trading. But basically, let's just go ahead and get a level. I just use a regular trend line on here, and I used to have something marked off that was literally SL. So let's just go ahead and mark this line. And then I think I may have the template. Yes, SL. So I created this template inside of TradingView. And if you want to do this, it's super simple. Just create a trend line like we did before. I give it text. I change the color of the text. I change the style, and then all of that. And then once I get the stuff that I'm looking for, I just go template and then save as, and then I give it a name. So I just named this one SL because this is my stop loss, and this is generally something that I use for my own trading. All right, cool. So let's just say if we got into this move, let me get rid of these fibs because it's a little distracting now. It's a lot of stuff on this chart. All right, we took this, we got in right here, and then price made this move up, formed a resistance, and then also formed a support. So once this little support right here was made, then I would put my stop loss right about here. And then basically everything above this line is going to be good. It means that there's no reason for me to get outside of my trade. And then also for those of you who are a little bit afraid of staying into the trade because you're afraid that it's going to reverse, or you're afraid that you're going to lose money on the trade, this was something that really helped me just kind of stay in the trade and just understand that market structure is still being respected, and there's no reason for me to get out of the trade unless I was already satisfied with the amount of money that I was making and all of that. But generally, having this little line just reminded me structure is still being respected. I need to stay inside of the trade. So as you can see, came here, pushed up, came here, and still didn't break this line. And then it did this, and then once it would have made this right here, this higher high, well, it's not technically a higher high yet because this isn't broken, but basically made this higher low, then I would have moved this up. So theoretically, you could have taken this line and you could have moved it right there. When that was created, same kind of idea, market structure is being respected. And then right here, moving it right there. And then instead of, sometimes I would set it inside of my broker, and then other times I would just use basically an alert, or maybe like a pre-alert, where basically just do it, a little bit ahead of time. So that way I knew that the stop loss was coming. So just something in order to kind of protect myself. But a lot of times what I would do, once I moved past the break even stage, I would move my stop loss inside of my broker a little bit past even. So that way, if there was some crazy spike or some crazy happen inside of the market, at least I would be basically at break even. And then I would walk away for maybe an hour or two or whatever, because I do work full time and I can't be sitting on these charts all day because I need to work. But basically, looking at it in this manner, then it helped me just kind of see really quickly, okay, we're still good. Market structure is still being respected. Stop loss not hit. I'm still good in the trade. So I would just do that. So every support level, like I would just trail it like that, like that, like that. And as long as it's being respected, I'm still in the trade. So this was another way or another thing that I used in order to help me really keep my mind focused on market structure and not be shaken out of trades early. Another thing that I would do inside of the market, and I'm starting to do this a lot more, especially because I do more swing trades, and that is to use moving averages. So right now on the moving averages side, I look at the 50, the 100, and the 200, and I'm using these higher values because I'm a swing trader, and sometimes I may be holding positions for days or weeks or even months, especially for some of the options trades that I take. So for instance, I held a meta position for 3 weeks and cashed out on that yesterday. It was actually really nice. And it was all good. And basically I was using moving averages and making sure that price wasn't breaking those levels in order for me to stay inside of the trade. So you can do the same thing on gold or any other market. You can see right here that this is actually moving quite nicely. And right now we've been on the hour time frame. So a lot of times during the trade, I will click to the lower time frames and just kind of see what's happening. So what I found generally is that the 30-minute is essentially my sweet spot when it comes to monitoring the trade. Of course, the higher the time frame, the better. Sometimes I will look on the 15, but as you can see, with this price action right here, it's actually hugging it quite close. And if you feel comfortable with that, then yeah, go ahead and use the 15. But if you prefer something with a little bit more substance, then maybe the 30-minute is going to be best for you. You can see that there's a lot of space between the actual candles and the levels. So that is something that's comfortable for me. Like I said, I will use the 15, but I do not use the 5. I know some of you use it and it works out perfectly, but for me, it's just too noisy because in this situation, price would have went up, it would have came back to here, and then I may have gotten out of my position because this price came all the way back to here. And now it's hugging it and you can see what it's doing. To me, this is not enough time or a high enough time frame for me to get a sense of whether or not I should still be in the market. Like I said, it's going to be 15, 30, and up basically, pretty much no higher than maybe like an hour, just because once you get to these higher time frames like H2, just the distance between where price currently is and where the moving average line is just going to be way too far. So like I said, it's kind of like a sweet spot kind of in between the 15 and the H1. You just got to play with the different time frames, and depending on which market you trade, that's also going to make a big difference. If you're trading a slower market, like maybe a Forex pair or something like that, then perhaps these lower time frames may be just fine. The 5-minute could be fine. But if you're trading something with a lot of volatility like gold, at least from my experience, then these time frames in here are going to be the time frames that I would use and the time frames that I'm currently using. So that was the third method that I currently use when it comes to trailing my stop loss or setting a stop loss. In those 3 different scenarios, if you use a combination of those things, I think you'll be totally fine, because I find myself doing that as well. And then it just gives me a better sense of where my stop loss placement should be. And another thing that has taken me quite a while to learn was basically you would hear all these things online about people setting really tight stop losses, whatever that means for whatever market. But basically having a tight stop loss doesn't mean anything if you're constantly being stopped out of the trade. I used to hear people talk about like 10 pips, 15 pips for these swing trades, and that's amazing for them, but that generally didn't work out for me. And that's why I said when it comes to me setting a stop loss using these methods, like these are the methods that have really helped me be able to stay in the game and actually make money from these markets instead of getting stopped out 50 times before I get a winning trade. we talked about 3 different ways in order to set your stop loss. The first method was using the Fibonacci levels. And basically you want to use the levels as a guide in order to figure out where your stop loss placement should be. Now, setting it right on the level is not something that I tend to do, and that never tends to work out really well. So I like to place it below the level. And if you want to get even more fancy, you can let market structure play out a little bit and then figure out what the distance is and then kind of use that as a guide for the other levels in the Fibonacci sequence in order to make sure that you set your stop loss accordingly. And then the second method was actually using market structure. That has been pretty much my bread and butter for years now, and it's something that I do use still to this day. And number 3 is using moving averages. Especially as a swing trader, I use the higher values because I want to make sure that I actually have something of substance when I'm looking at the chart really quickly. So I tend to stay away from lower time frames and more focus on those higher intraday levels such as 15, 30, H1, and so forth. If you like this video, go ahead and give this video a like, and then go ahead and let me know in the comments what you liked about it. And if you have a different way of setting your stop loss, I would love to hear it inside of the comment section below, and I'll see you next time.